Welcome to KiwaniTalk. My name is Gary Gardner. Welcome to the program, which is the longest running cable access television show in the entire world. We are in our 1,152nd episode, which something like that, which has been around for a long, long time. We're happy to talk about many subjects, and today we're talking about something that I'm sure everyone's excited to talk about, happy to get involved with it. It's income taxes. Or am I wrong?
No, they're always happy. I'm happy.
And to help us talk about income taxes, we have Jerry Assenmacher, member of the Kiwanis Club. He's been in the club longer than I have by about
2 minutes.
2 minutes. We got sworn in on the same night, way back. Was it right after the Earth's crust finished cooling, Jerry?
It was a long time ago.
Well, not long as some of the people in the club, but welcome to the program.
Thanks, Gary. Appreciate it.
Now, besides being a long-term Kiwanian, you also are an accountant. But before you were an accountant, you had a life. Where'd you grow up and where'd you go to school?
I grew up in Dearborn, went to grade school at Sacred Heart, transferred over to Dearborn High, actually Adams Junior High for 1 year, and then went to Dearborn High for high school. Following, I took a few courses over at Henry Ford Community College, and eventually at the ripe age of 26, decided to go back to school and got my degree in accounting at the University of Michigan Dearborn. Followed that up with sitting for the CPA exam and then getting my master's degree from Walsh College in taxation.
What was it that brought you to accounting? Why did you think you wanted to become an accountant?
I love numbers.
That's a good place to be, I guess.
And my wife says that I butcher the English language. So I had to find something that wasn't going to involve me having to be using words.
And when you say CPA, what does, we hear that term, but what does a CPA mean versus an accountant person?
Well, to some of my clients, CPA stands for constant pain in the, or we'll just leave the last blank, but it's a certified public accountant is someone who's required to take an exam following, after they get their a bachelor's degree, they have to sit for an exam. It used to be, when I took it, it lasted over 3 days. They also were required to put 2 years minimum working with a certified public accounting firm before they could become certified with the state of Michigan.
And as a certified public accountant, what does that mean that you?
I work with businesses. I'm their independent accountant. I'm not working for their company. I'm actually coming in. Oftentimes it's if they need, the banks have asked them to have someone look at their books. I will come in and I will review their books. There's many different levels that I might be doing for them, but basically I'm looking at their accounting and making sure that they're following all the rules and everything's where it's supposed to be.
And how long have you been doing it now as a public
1986. I
can do the math real quick. 86 till now is
33 years.
Very good. As a test to see if you can actually do the numbers like you say you do the numbers.
Yeah, 33 years.
And my youngest daughter just finished her last leg of the CPA exam. She's working for a big company, Plant Moran, and she's loving it. So that's a good thing. Yep. You work for businesses, but you also do individual taxes too?
Yeah. In addition to doing work for businesses, I do probably about 325 personal tax returns for people, and that's where I'm at right now at this time of the year. It's tax season.
And we're filming this the first week in January. It'll be shown through January and February, and it's getting fired up. Yeah,
beginning January 28th, you'll be able to start filing your income taxes. Up until January 28th, if you do your taxes online, you're not going to be able to submit them until that date. And then, obviously, if you mail them in, which very few people do any longer, they won't start processing those returns until January 28th.
Let's talk about the online capacity just for a second, too, because it seems that years ago there was no online filing of taxes, and how has that changed what you do and the way you do it, Jerry?
I don't know what the percentage is that's being done online, but if you're a preparer and you're doing in excess of 250 personal returns, you are mandated by the federal government to file all of your individual tax returns online. Now, the client could come to you and say, I don't want you sending it electronically. Then they have to sign off on a form that you have to submit with their return saying that they do not want you to file their return electronically. I will tell you, though, filing the return electronically is a lot safer and a lot quicker, especially if you're getting a refund, if you do it online. If you just think about it, when you're mailing in a tax return, right on the outside of that envelope, it's saying the Internal Revenue Service or to the Department of Treasury. That's the first key that inside that envelope might be your personal information, including your name, address, social security number. So it's really something you probably don't want to be putting in the mail in this day and age.
And as a preparer for 33 years, or maybe longer before you got your CPA, how much easier is it to do it electronically than it is to fill out the forms manually or however you did them before?
Well, most of your software now, even your personal software that's out there that you can purchase yourself, the software is going to do a lot of the math that when you're doing it by yourself by hand, you know, there's a really good chance that you're going to make some sort of an adding error, or you might take a number that's got to go from one schedule to another schedule. You may transfer it incorrectly. That's generally not going to happen if you follow the software.
So as a CPA, do you think that a person should or be doing their own individual taxes?
Heck no.
Well,
they should be hiring a professional that knows exactly where everything should go, and on top of that, making sure you get every deduction that you're entitled to.
because the TurboTaxes and the whatever software packages are good, but the institutional knowledge of all those things and what to ask for and how to ask for it.
They're only as smart as what you tell them. And so if you don't know all the questions to ask TurboTax, then you might be leaving some deductions on the table.
And also over the time that you've been practicing, tax rates have changed.
Tax rates have changed
A
drastically.
long time ago, they were, when Jack Kennedy, but that was before you were practicing, but top marginal rate, I think, was like 95%.
Well, let's move forward a little bit further than that. The Tax Reform Act of 1986 under Ronald Reagan brought the highest tax rate down. I believe at that time it was sitting at 50%. And so, but yeah, I don't know if they've ever hit 90, but they've hit it up into the 70s. But in most recent, when I say recent, the last 40 years or so, 50% has been pretty much the highest rate. The tax rates now, the highest rate under the new act is only 37%.
Only 37%.
Only 37%.
And were that we could make enough to earn the 37%?
Well, to hit the 37%, I believe, and I'm shooting from the hip on this, I believe you got to have income in excess of $600,000 if you're married filing jointly.
So the tax situation that we have now, there was big talk by President Trump on the campaign. He's going to change the tax system, make it simpler and easier. And how's that working out?
Well, in 2017, in December of 2017, President Trump signed into law the Tax Cuts and Jobs Act, which is probably the largest overhaul in the tax code since, some people will say before the Tax Reform Act of '86 with Ronald Reagan, but it is by far definitely the biggest change since then. We had some widespread changes. One of the things that the President and Congress had talked about was the idea that you're going to be able to file your income tax return on a postcard or the equivalent of a postcard. They didn't quite make that. A basic 1040 return was 2 pages in the past, 2 full pages. What we have now is we have 2 half pages. So it's actually going to take you 2 postcards to be able to file your
Or
income
front and
tax.
back of one postcard.
Or front and back of one postcard. But it is going to be, it's going to look very similar to what you saw before, other than it's going to be much shorter. But it doesn't mean it made it any simpler, because there's now 6 new schedules.
Okay, what's the schedule?
Schedule is where you have additional information that you must tell the IRS. These are in addition to all the old ones that many people are familiar with. Your Schedule A itemized deductions, your Schedule B interest and dividend income. These are 6 new schedules, though the average person is only going to end up using 3. There's only 3 of them that are probably going to be commonly used under the new Tax Act. But what you've got is just widespread changes that are coming into effect for 2018. And I just saw something today that I was reading online, and they claim that 75% of Americans are not even aware of how the changes are actually affecting them. They're just waiting to do their tax returns and see how the results come out. But there are just huge number of changes, starting with the rates. The rates were as low as 10% under the old tax law, as high as 39.6. We still have just as many rates as we did before, but they start at 10 and they end at 37. Every single one of your rates as you go up are about 2 to 3% lower than they used to.
So what does that mean for the average?
Well, we have what they call a graduated tax rate. Graduated tax rate basically means that, and I'm going to make up numbers just here, but
You're
for
an
the
accountant,
first,
you make up numbers
well,
for a living.
the first $10,000 of income under the old law was taxed at 10%. Under the new law, for all intents and purposes, still taxed at 10%. The next, if you're married filing jointly, the next 60,000 approximately is going to be taxed at 12%. So the first 10 is at 10%, the next 60 is at 12%, and then it goes up from there. After that 70,000 approximately rate, from there it goes to the next rate, which under the new law is 22%. Now in comparison, the old rates were 10, 15, and 25 for those first 3. Now they're 10, 12, and 22%. So that's what they mean by a graduated rate. So when you hear the politicians, and recently we've heard this on the news, when you hear the politicians say that they want to see the rates go up to 70% on the high income tax individuals, when they're talking about that, that is a graduated rate. That 70% tax rate would only be on dollars above a certain level. So right now, our highest rate is 35%. 37%. That's only on income above 600,000.
So you don't pay 37% on all $600,000. You pay 37% on monies above 600,000.
Above 600,000.
Look, I'm safe then. I'm not going to worry about it.
You know what? And that really bothers a lot of people, because they hear, I don't want to get any more income this year because I don't want to jump into a new tax rate. And I'm going, you got to explain this graduated rate.
The theory is that people used to believe if you went from one rate to the next, say you went from $100,000 to $101,000, you'd pay $10,000 more in taxes.
If you jump, and that's not true.
But you pay your taxes in the first $100,000 at the one rate, and then the next $1 is paid at the next higher rate. So it's not. So don't be afraid to make money.
Right.
To avoid paying taxes.
And if you think about it, even at a 37% tax rate, that dollar, you may have to pay 37 cents in taxes, but you've got 63 cents more in your pocket.
The government's very nice to let you have that
money. But it is from a tax rate. You should never not try to make income because you're afraid the taxes are going to be. outlandish.
Well, we're going to continue talking about taxes and get into some more of the nitty-gritty with Jerry Assenmacher, CPA, longtime practitioner, Kiwanian longer than I've been, but we'll get some messages right now about Kiwanis. Don't go away. This is getting to be exciting in a minute. Don't go away.
There's never been a better time in our history to be a member of Kiwanis. The impact that we can make is at an all-time high, but we need more members so that we can reach our potential. You can help and lead by example. Invite your family, friends, and coworkers to your club meetings and service projects. Tell them about our service leadership programs. Ask them if they want to improve the community. How can anyone say no? We need to step it up and focus on what needs to be done with our membership because kids need Kiwanis today.
Welcome back to KiwaniTalk. I'm your host, Gary Gardner, with our special guest, tax expert, professional, CPA, Jerry Assenmacher, fellow Kiwanian, talking about the exciting changes in the tax laws from 2018. Now we get to file our returns. And the size of the, I'm going to hold this up just as a little bit of a thing here. This is the front page of your tax return.
That is the front
That's
page.
all it is. It's a big postcard, but it is indeed a postcard.
Yep. Well, it's a sheet of paper, but
And
the
this
size of a postcard.
That's the second page. So basically, information that you need for most taxpayers, or many, many taxpayers, will be able to have on something that efficient. So
Yep.
part of the president's hopes and dreams have come true as far as that's concerned.
Yep.
What about the tax rates in those, and what do we have to look forward to, Jim?
Well, you know, a lot of people have asked me what the new tax rates, what the new tax law, who has benefited from it. I think probably one of the biggest benefits is for families making under $400,000 with children under the age of 18. The child tax credit has doubled. Child tax credit in the past was $1,000 per child for any child under the age of 17. But it got phased out for a married individual. It started phasing out at $125,000. It was gone completely by, I believe, $135,000. That phase out amount, that's income, is now $400,000. There are going to be a number of people who have never gotten a child tax credit in the past are going to be able to benefit from it in 2018. And in addition to that, they're going to get double of what the credit was prior.
So that's good news for people.
That's great. That's
Although
great news.
I'm not going to run and have any more
Right.
kids right now because I've served my time on that part
That's
of my
right.
life. So
The second item is that the standard deduction, which in some cases does confuse people, but the standard deduction is doubling. For a married filing joint person, you get a standard deduction of $24,000. If you're a single person, you get $12,000.
what does that mean?
Well, that means that you get the higher of a standard, the $24,000 if you're married filing jointly, or your itemized deductions. Your itemized deductions are your state taxes, your mortgage interest, your charitable contributions. Those are the main ones. For some individuals, it's health, it's medical expenses as well. But that is going from $12,000 to $24,000.
What does that mean? So say I'm earning $40,000 as my paycheck, my gross pay.
If you're making $40,000 and you're married, you're going to get $24,000 minimally. You're going to get $24,000 of that tax-free.
So then you only have to pay tax on $16,000.
Only on the $16,000.
And the first $10,000 is at a lower rate, and so
It's going to be the graduated rates. Now, with that, there is something you're losing, though. In the past, we also, each individual in your household, you got an exemption of $4,050. Again, take it off your 40 grand. So if you had your wife, you, and 2 children, you got $4,050 each or $16,200. So in your case that you're talking about, if that still existed, you'd have no taxable income. But that exemption's gone away. They've eliminated it. So you no longer get your personal exemptions. There are a couple other things that have come into play in this, and this is two of the most controversial ones, is that for people who can itemize, they can get above that $24,000. Again, if they're married, 12 if they're single. They're only allowed to deduct state and local income tax, state and local taxes of up to $10,000. Now, some people think, well, that's not a bad number, but think about it. For someone living in Dearborn, there is the possibility their property taxes could be as high as $8,000, $9,000. Let's use the $9,000 rate. If they're living in, in a home that's worth $300,000, $400,000, their property taxes could be $9,000. They're working. They have $3,000 of Michigan income tax withheld from their pay. They got $9,000 of property taxes, $3,000 of Michigan income tax. That's $12,000. They used to be able to deduct the whole thing. Now they can only deduct 10. It's capped.
And part of the thinking was too is that high property tax states like California and New York, the federal government was subsidizing the states because when you have a $50,000 tax bill on your $1 million house, and the state is subsidized, and you can deduct it all. That is probably a large part of where that came from.
That's where the biggest screaming came from was New York and California. Now, on the flip side of it as well, if you take out a new mortgage, and this is after December 15th of 2017, if you have a new mortgage, under the old law, you could have a mortgage of $1 million or less. You could deduct all the interest, your mortgage interest. Now it's $750,000. New York and California, very difficult to find housing that is under $1 million in those types of states.
An 800 square foot house in Los Angeles is about $1 million.
Yes,
yeah.
yes.
So.
In addition, this is the one that's going to affect, I think, people the most if their tax preparer did not prepare them for this coming into the year, and that is home equity loan. Outside your mortgage, you've gone and you've taken a second mortgage, but it's a home equity loan, no longer is deductible under any circumstances.
Not even if you use it for investment or other purposes.
Now, not even if you used it and put it into the house. So tax preparers, hopefully when they were meeting with their clients last year, they were telling them, go get those home equity loans, pay them off, or refinance their mortgage and fold them into one because home equity loan is no longer deductible. I'd like to bring up one other thing too with all the new stuff, because this has been talked about quite a bit, and this is for your seniors that are starting to collect on their IRAs. Their required minimum distribution they must take out of their IRAs after they turn 70 and a half. Under the new tax law, there is going to be a huge amount of people who have been able to itemize in the past that are no longer going to be able to do it. So there is an availability for you to give money to charity directly from your IRA or your required minimum distribution and take it and not have to claim that as income. So in other words, if your required minimum distribution is $5,000, you could take that $5,000 and you could have it directly given to your favorite charity. Say it's your church. You could have that, and you do not have to include that $5,000 on the front page of your tax return.
So what happens is you're required to take it because of the federal laws, but you're not going to get taxed on it because it's going to be, and you're getting the benefit of giving it to your favorite charity organization.
And there's so many people right now that are no longer going to be able to itemize their deductions because most seniors don't have a mortgage any longer. So they're not going to have a very difficult time getting to that 24, which, by the way, if they're married filing jointly, is 24 plus an additional 13 for each spouse. So it's 26.6. They're not going to likely be able to get to that 26.6. So they're not going to get the advantage of deducting that charitable contribution. So now they can give it away with dollars that they have to take, but they don't have to pay taxes on.
Well, we're down to about our last 3 minutes here, Jerry.
Sure.
And so, by the way, if someone wants to get a hold of Jerry Assenmacher, CPA, how can they reach Jerry?
I'm on Monroe in Dearborn, off of Otter Drive. I'm in the Dearborn area board of realtors. My firm is Assenmacher and Associates. If they have any questions, I'd be more than they can give my office a call.
Phone number?
313-277-5800.
Very good. And you have a website or email?
I have an email. It's just Jerry A. 1216 at yahoo.com.
Jerry A. with a G or a J?
J with a J.
Jerrya.
Jerry, the letter A, 1216 at yahoo.com.
Yahoo.com.
Yeah,
Okay,
send me
a
an email
couple
or
of bullet
and I'd be
points
more-
now in the last 2 minutes.
Yeah. Okay. Some bullet points. For people who have always been concerned about their estates, that is not a big issue any longer unless someone is really, really rich. The lifetime exemption for an estate now is $11 million per person.
I'm safe.
Yes.
Next.
Most of us are safe. So a lot of the trust planning for higher income, wealthy individuals is really gone by the wayside from an estate tax point, because between you and your spouse, you can $22 million you can pass on to your heirs.
I'm really safe now.
You're really, really safe. For those that are out there that don't have health insurance, beginning in 2019, they've been paying, I call it a tax. They've been paying a tax for not having health insurance. This is under Obamacare. The new Tax Act has eliminated that mandate. So beginning January 1st of 2019, there's no longer a mandate.
Don't have to have the certificate.
You're
to
not
file.
going to get. You're not going to get a penalty for not having it. For people who have businesses, I'm thinking about people who are sole proprietors. I think about real estate agents, insurance agents, things like that. No longer is entertainment deductible.
Not at all. No meals.
Zero.
Okay.
Zero deductible, and that started in 2018.
Been winding down. Well, Jerry, I tell you what, there's a lot more things here.
Yep.
If you need tax work, you're getting it done. Jerry Assenmacher, real quick, phone number 313.
313-277-5800.
And when you fill out your tax form this year, remember it's a little bit smaller, but you don't fill it out. You do it online with the computer and everything else.
Or you call a tax professional and
There you
have
go.
them help you out with that.
Thanks a lot. Enjoy 2019 tax season. Gary Gardner from KiwaniTalk. See you later. Bye-bye.